All right. Well, good afternoon, everybody. It's 2 o'clock Eastern Standard Time. Welcome to McQueen Financial Advisors webinar. We're going to be covering the market trends, doing some smart investment strategies for today's markets. And just a little introduction about McQueen Financial Advisors. As most all of you know, we're a nationally recognized SEC registered investment advisor providing asset liability management, CECL, valuations team doing valuations of all types of assets and servicing assets, as well as transaction advisory. And then we also have McQueen Charitable Solutions, which is providing asset management for endowments and foundations and pensions around the country as well. So really good, strong team, diversified, providing great service to all of our clients on a daily basis. Joining me today is the Mr. Zachary Montroy. He is an advisor with a lot of our clients across the country. He's providing asset management advice to them on what to do with their portfolios and managing their balance sheet, utilizing asset liability as a tool, and using our simulator to help to decide which direction each client should be going in. He manages a very large amount of assets for his clients and does a fantastic job. Zach, thanks for joining us today.
Thank you for having me. I'm excited and looking forward to some of the questions we get.
Excellent. I'm Craig Cecilia, our Chief Investment Officer, Managing Director. I work with all of our advisors and a lot of our clients as well, and doing some board education, strategic education as well, and just happy to have everybody joining us. So thanks again. Quick administrative topic here is our webinar will be recorded. It'll be on our website as all of our webinars are. When you get emails from our advisors, there's always a link at the bottom through their after their signature to either register for future webinars or even look at old webinars that are onto our YouTube channel as well. We will have our chat feature open today, so you can ask questions throughout the presentation. And I mentioned chat, so you can either do it through a chat or the Q&A. We'll be monitoring that as well. Anything else, Zach, that I've missed?
No, let's kick it off and get into the meat and potatoes of today's presentation.
Let's rock and roll. Ready to go.
Absolutely. So first thing, we're going to start off with the current trends, what we're seeing with our clients, what we're experiencing in those marketplaces, talk a little bit of long-term strategy and how we can set our institutions up for success, discuss value and what we're seeing out there in the market today, touch on a few of the asset classes that we, skipped out on in Investments 101 or the first investment webinar we had, and then leave you with a few key takeaways before we end the presentation.
Excellent. Thank you. Okay. Some of the trends we're seeing in the marketplace for pretty much it's coast to coast across all institutions. Loans are slowing up a little bit. And I don't think it's anything that the financial institutions are doing incorrectly. I think it's a measurement of what's going on in the economy. Would you agree with that?
Absolutely. Applications are down. My clients are telling me that they're just not even close to the volume they were last year. So if your institution is experiencing this, you're not alone.
Gotcha. And along with that is delinquencies. I think it's been, debated heavily on, depending on which talking head on the news you're listening to or what political figure you're listening to. We've got some issues happening in different asset classes, and delinquencies and charge-offs are actually rising right now, and several of them.
I've heard we're back to pre-pandemic levels, if not above at some of my institutions. So I would agree with you. Delinquencies are on the rise.
Yeah. So, and with respect to loan slowing and deposits really are not contracting right now. We do have liquidity returning to balance sheets, right?
Absolutely. As those principal pay downs outpace applications, the money's coming in faster and we can lend it out, and we're seeing cash build up.
Yeah. So this is why it's so timely to have today's webinar on, the market trends and smart investment strategies, and some of which some clients are doing and people out there are doing, and some which are not. And we're hoping to find a little bit of value for everybody out there, and something that's a little bit atypical than we'd normally, excuse me, have the hiccups would be running to. So it's very timely with all the liquidity out there. You might have to take a few extra slides here since I got the hiccups here, Zach.
Absolutely. So let's move on to our next one. I know Warren Buffett announced his retirement, so I got a couple quotes in here, right? So, someone sitting in the shade today because someone planted a tree a long time ago. So, how and what does this really mean for us today in today's presentation? We're looking to secure the income for many moons to come, locking it in. How can we set ourselves up for future success?
I love it. I love it. Warren's the GOAT, man. He really is.
Taught me a lot.
Right. Absolutely. And a lot of people. All right. Yeah.
So let's jump into strategy. We talked a little bit in the previous investment webinar about building the ladder, but some of the other things we want to touch on today is leverage, swapping securities, and maybe repositioning that portfolio, um, with a more current market coupon.
Absolutely. And I think, depending on what strategy we're going to be talking about, it's going to be unique for each institution out there. Is that right, Zach?
Absolutely. We're definitely going to recommend you, one, talk to your advisor, but two, run these through a simulation. Examiners have really been asking us quite a bit about that, and if we've stressed and taken a look at what that's going to mean for our balance sheet down the road.
Absolutely. Okay. Well, it looks like we want to start talking a little bit about security swap, and these have been in vogue for quite some time now, right?
Yeah, this is
What
probably the one that most people are the most familiar with, right? Selling out of securities, moving into another set of securities, a security for security swap, if you will. There's obviously some things we have to consider when doing this, right? What's the loss on sale? Are we going to be increasing income going forward? How long are the assets we're putting on versus getting rid of? Right? What's that break even period look like? When do I become profitable on this transaction? Am I taking more credit risk or less credit risk? Right? The net result, are they executable? Is the action item something we're willing to go forward with? And then again, talking about that simulation and what it means for the overall balance sheet going forward.
Yeah, I really like that last point there that you're talking about. All of them are really important, but the simulation is extremely important to really understand the impact, not only the immediate impact, right? What is the immediate impact to our income statement, but what is our go forward and income increase? And how does it affect our entire balance sheet, right? Because it could have a impact on net interest income, but it also could have a big impact on our NEV risk or our income sensitivity. A lot of people don't realize it or think about it this way, but this investment portfolio on all of our institutions is the really one true asset that they can utilize to impact interest rate risk, right?
Absolutely.
Yeah, using the right set of securities, they're not relying upon anybody themselves to decide how it's going to impact it. So it's a great tool, and simulations are extremely important. And I love that we have that online navigator that we can run those simulations on of liquidating out something and buying another one. So
Before we move on, I wanted to touch on why we bring security swaps to this webinar, right? So we've seen some movement on the yield curve since this time last year. It's a little bit steeper, the back end high yielding higher than some of the, shorter term tenors. And that's what's bringing this back to the forefront. This is why it's becoming popular. Security swaps are trying to make sense, are starting to make sense again, right? If we can lock in a little bit of duration, we can increase that yield, and that's why they're coming back. Um, when when that 5-year bond was yielding less than the 2-year bond, we had a little bit of problem having these make sense, right? Nobody wants to lock in less yield. So now that we're able to lock in more yield, these have come back, and we're starting to see more and more of them.
well said. Well, this kind of puts things in perspective as well.
Yeah, absolutely. As you can see, back in 2024, all the big banks, let's call them too big to fail, were executing swaps. They were realizing losses in their security portfolio in order to better position themselves going forward. I know a lot of the institutions on the call today fall in one of those first two buckets. But again, that averages out to be 1 in 4. So one out of every four institutions is realizing a loss in their security portfolio and then setting themselves up down the road to make more income.
Yeah, Zach, sometimes that loss on sale is just a tough pill to swallow.
Don't I know it? Things got pretty ugly when the Fed raised rates 500 basis points in a year, right? So, those unrealized loss numbers on the call report got substantial, significant, and scary in some institutions.
Absolutely. And what we've seen is what you had already mentioned is we have some shape to the yield curve, and what I call it is an absolutely beautiful yield curve, right? Positively sloping is beautiful to me. And rates are, they're higher than we were in that really low long rate environment, but they have come down a little bit. And so with the positive slope and them coming back down off a little bit, they're really presenting some good ideas, and that's why such a large number of institutions are actually doing this in the marketplace. So here's just a rough math. Just, hey, what are you guys talking about swap? The tough pill to swallow on doing a security swap is that loss on sale of a group of securities. Here's an example of a group of 5 million securities where you're selling off some securities, losing 116,000 versus book. But then we get a couple hundred basis point pickup on the reinvestment side. That's an annualized number for $100,000. Your break even period on this, meaning how much of this additional income makes up for that loss on sale, is 14 months. So simple math again, we've seen transactions depending on, everybody's different depending on when they booked, what they booked, what's the duration of what they booked, and where we can roll into is different. Sometimes it's less than a year on these pickups as well, right?
Yeah, so let's talk a little bit about that, Craig. So if we're coming to if this swap were to come across your desk, there would be a couple questions, right? What kind of additional credit risk am I taking? Am I de-risking or am I adding risk to the portfolio? What about duration? How much longer am I locking in that extra income versus what I'm selling out of? Does it make sense? Is this $116,000 I have to eat this year going to set me up for 5 years or only three? These are the things that I think are important to take into consideration when we're talking about security swaps.
Sure, absolutely. Going through that checklist is extremely important. And at the end of the day, there's going to be some that really do make some sense. The other side of things does it have to flip into investment security, right?
Doesn't necessarily have to. We could always sell, take a loss, and put them on in some loans.
Right. Get a little more in yield enhancement instead of picking up only 200 basis points. Yeah.
Absolutely.
And that's for properly priced lending rates where, you got to be up in that 5, 6, 7, 8, 9% area. So,
Absolutely.
okay. Well, what's this? What's this repositioning? This is kind of unique of what
Yeah.
I've been
So
hearing.
Yeah, so some institutions might be looking to take a loss on their portfolio, sell out of some of those, 1, 2, 3% yielding securities, right? And get into some more current yields that north of 4%. Obviously, those are pretty large losses that you might be taking if you're selling a 1% yielding security and putting on a four, that might take some time to recoup, and that break even period might be longer than you at the institution are willing to accept.
Okay. I gotcha. So what am I looking at here with a branch sale leaseback?
Yeah, so one of the ways we can help offset that break-even period is by adding capital or creating a net income gain. So if I have an asset, let's call it a branch, on the books for a relatively low price, let's call it an even $100,000, and I go to sell it today, it might be worth 500,000 or a million. We'd be taking that as a capital gain, and then we work out a contractual agreement where your branch can stay there 10, 15, 20 years. That's all part of the contract. We'd love to help you with it. But What we can do then is turn it into an expense. You take the capital up front and you're able to shorten that break even period.
Yeah, interesting. Um, Yeah, it doesn't change, from my understanding in the accounting world, doesn't really change your fixed asset calculations whatsoever because that at least needs to be calculated, but does free up that equity and liquidity there. And you can offset some security losses. Some of the proceeds you can actually reinvest into the securities. Develop another branch, lower cost, square footage, a lot of different things you can do with that. Yeah, it's interesting.
Yeah, what we're trying to do here is maintain the spread and help protect that margin. So if we're able to acquire current coupon assets at current yields, that's going to allow us to maintain that spread here as we talk about going into a lowest interest rate cycle.
Okay, excellent. Visa B is something that we don't hear a ton about. I know it's some illiquid stock that a lot of institutions received from settlements with credit card companies back in the day.
Yeah, that's been sitting on a lot of balance sheets since 2008, 2009 at relatively small cost basis, right? We're hearing we have a couple institutions looking to turn some of those non-earning assets into, a decent chunk of equity. Um, the discount on them right now is favorable considering we've seen Visa A's growth, and I think it's a nice opportunity in a year where income might not be a stellar year to turn that around.
Yeah. And from all the transactions we've done in the Visa B world, it's majority of them, the cost basis, the book value has been zero. There's some that have been a little bit higher because they were brought on through a merger or an acquisition of an entity, but for the most part, their cost is zero. So it's another way to monetize and reallocate, which is interesting.
Absolutely.
Another thing that we've been seeing, it started in 2024, really beginning of 24 was big, and it's still happening now, is the insurance world as well. Taking security losses out of your investment portfolio and then utilizing an insurance product to actually offset some of those losses. And they're doing it through a variable product is what they're doing it through. And ultimately, they started off saying, "Hey, you can just do a so let's say going rates on these variable rate product would be on call it a 5%, but you can take instead do a contractual relationship at 4.5. So all of a sudden, you're only earning a 4.5. Markets are 5. You can get a mark to market that's instantly more than you put into it. That gain in markup on that insurance contract offsets your losses in the sale of securities. There hasn't been a lot of adoption of agreeing with that, the accounting firms. And so, but what the reinvention of that now is actually to look at it from over a period of time. So doing an enhanced yield instead of market rates being 5% on the insurance product, earning a 7-8% for a short period of time to get those additional earnings to make up for those losses, that what we called it was the earn back period to go shortens quite slow or quite quickly. And then it kind of adjusts after it's been earned back. So it is an interesting product. It's not a ton of liquidity in that, but it is a product that we've seen people utilizing to try to get back to some normal high earning assets.
Yeah. And then I think the last one we have on here is securitizing loans and packaging up and yeah, I don't want to call them a syndicate, but offloading kind of like a participation, but you're not retaining any portion for your balance sheet. Selling those off and moving those on in a securitized product so that another institution or um, maybe even another investor altogether is going to pick those up.
Yeah, absolutely. Now, typically these security goes into asset-backed security, and the size scale has traditionally restricted a lot of our community institutions from doing this. But especially in the credit union space. I know we have banks and credit unions on, but in the credit union space, they've now got a just recently passed 2 months ago by the NCUA of club securitizations where they can sell off smaller portions, say a block of 20 million into a club securitization where other institutions are also providing the collateral into that asset-backed security. So all of a sudden, the scale doesn't need to be there to make it happen. And when doing this, the really cool thing for our income enhancement is you retain 100 basis points of servicing. There's going to be another 100 on top of that of excess spread. And the beauty of it is once it's securitized, you get the liquidity for the loans that you securitize, and you can go out, rinse and repeat, go out and re-lend that money out, almost like a leveraging transaction, with the exception is you're not still earning on that old asset with the exception of the servicing, but you are being able to lend out again. So kind of a neat little product out there that people are starting to adopt and utilize.
One more time, I know we touched on it, but went kind of fast there. What is that minimum size I would need in order to, to look to club securitize some loans?
It really depends on how many other institutions at the time the securitization is taking place, but somewhere around 20 million is what they would prefer to have. Okay. Yeah, the asset-backed security itself would be up to about 200 million for a security for marketability and what investors need and want. And then you got economies of scale to take up some of the fees that are involved from the legal and the broker dealers that are underwriting it and whatnot as well. So, but yeah, that's small, but about 20.
Thank you.
Yep, you're welcome. All right, leverage. What is leverage? I think everybody on this call is pretty much naturally understanding what leverage is, right?
Yeah, I think it has to do with there's a fulcrum in there and trying to move something with a little bit of pressure.
We're on the playground all of a sudden, little
Yeah, a
teeter-totter.
little teeter-totter. That
I'm
was never
sorry.
my game.
Well, I'm thinking you're up in the sky right now if you and I are in a teeter-totter together. But yes, you're borrowing money, you're leveraging up a balance sheet. Ultimately, we take in money from depositors and we lend it out or invest it. And basically, what you're basically in leveraging world is you're taking your assets and getting more liquidity to do something else with, invest or lend out there. So you're levering up that balance sheet. And that's kind of basically how institutions do it. A great example is our one of our great counterparties for everybody is the Federal Home Loan Bank. That's kind of leveraging, right? You can take your securities you already own, your assets, and pledge it, and then you get more liquidity that you can lend out or invest or do something with, right?
Yeah. Uh, one of the other, things that we talked about maybe is uh, using those assets to try to grow those assets. So,
Hmm.
mhm.
Yeah. So what are some of the risks though of leveraging?
Oh, I think there's quite a few. The first one that comes to my mind would be interest rate risk. What is there potential for a duration mismatch between what I have collateralized and what I bought? The asset I went into from the asset I pledged? Is there some optionality that I might be able to either take advantage of or that could hurt me if the leverage play is taking that callability out of my hands and is putting it in the home loan bank's pocket?
Oh, so you're not talking about only optionality on the asset side. You're talking about optionality on the liability side as well.
Yeah, I think we got to look at both as a risk.
Well, that's why they call you the king around here, I tell you.
Oh. Let me know who tells me that. I think another one of the risks that pops up into my head is capital risk, right? As if we're adding assets, we're going to be diluting our capital.
Yeah, can your capital handle a leverage transaction? And if the markets change, right? If we have interest rates going up, hey, this is not a call on interest rates, everybody. So don't, quote me on this. But if interest rates did rise a couple hundred basis points, right, we have that devaluation again of a lot of the asset side of the balance sheet. And can your, unrealized losses, unrealized gains, what is your rate? How does it impact your ratios? right? And how much capital do you have to actually leverage up a lot? So in a tough economic time, when you have a highly levered up balance sheet and you have some credit issues, it could also impact you a little bit there from a solvency standpoint. So you got to be really careful.
Yeah, I think you just touched on it right there is some of the liquidity risk concerns, right? If I'm using my assets to go out and acquire other assets, what happens when, I have either shrinking deposits or liquidity gets tight? Um, is that another one of the risks that you would consider in a leverage transaction? I think you should. You know,
Yeah.
uh, there's some options that don't necessarily require collateral on the other side, such as brokered deposits, but by and large, for the most part, you're using assets to acquire assets. So we have to be careful there as part of the contingency funding plan that we're not using too many of those assets.
Right. Or yeah, because or else the other thing is that we have had regulatory news where we've heard that institutions may be using sources on their contingency funding plan for just daily use. And so you want to make sure you be careful not to do that, or else all of a sudden they're saying that's fine and dandy, but now what's your contingency plan have in it type thing. So good point. And then credit, right? You got to be careful in the credit world if you're leveraging up. Sometimes ultimately you want to leverage for spread, right? Ultimately you want spread. We're a spread industry. And if you're borrowing for spread to redeploy into a nice earning asset, but you're utilizing a little bit of credit risk in there, and that credit deteriorates, or even something that you have pledged on leverage starts to deteriorate, you might have to repony up some new collateral and stuff. Just got to be really careful in doing that as well, making sure you understand that.
You touched on something here that I think we wanna dive a little bit more into, and that's spread. And I keep going back to something that Warren Buffett said, and I think he hit it right on the head here. Price is what you pay, value is what you get. Now, he was always a value investor. He, it's in every single book, every single article I've ever written, or not written, but read on the man, is value. So, Craig, how would you define value?
Well, uh, I think you're looking at value as spread over your riskless curve, right?
Yeah,
And where is it relative to the peers out there and industry averages, right? And is that a reasonable rate of return for the risk that you are taking?
I think that was beautifully said. Yeah, to me, value is the pickup over the riskless asset. Absolutely.
Gotcha. So thank you, by the way, for saying that.
Yeah, so when we get down through here, we're going to touch on asset-backed securities. We kind of already touched on it with the club securitization, uh, commercial mortgage-backed real estate and corporates. So, when we ask for value, what's been in the headlines recently that's been getting beat up? Where's somewhere where some people don't want to take the risk that we might find value, where we might find a pickup. So looking at asset-backed securities, we've kind of already touched on it. A collateralized pool, securitized, buy an asset, right? We're purchasing the cash flow. It's 100% risk weighted. A couple examples. This is not an exhaustive list up here on your screen. Credit cards, automobiles, student loans, things like that.
Home equities could be regular mortgages type stuff as well, right? Not
Yeah,
considered CMBS or MBS. Yeah, absolutely. So, going into these, there's a exhaustive list of pros and cons, right?
I, yeah, absolutely there is.
Yeah. I like how you brought up that sometimes there'll be excess spread in a product when the collateral is in disfavor to the market. But what you can get experience is a properly structured security that's has a lot of credit enhancement. Could be cross collateralization, over collateralization, certain credit steps required to be in that trust, that pool of collateral that really does provide value, and it's still a decent security. So why don't we talk a little bit about the pros in the asset-backed world?
Yeah, so I mean, kind of as you mentioned, one of the reasons I think we bring it here is auto loans have been slowing. This is a good example. We've been hearing a little bit of slowing down in the auto market. This might be a way to supplement that portion or that category or dare I say concentration on your balance sheet.
Are you making up a C word?
Ooh.
Oh,
I'm just trying to avoid the naughty list.
I understand completely. And we're starting to get different types of words instead of that whole R word. We have the T word now going on with tariffs, right?
Yeah, at least it's not transitory.
Oh my gosh, yeah, absolutely. Well, I think these tariffs might be transitory, but that's just me.
Yeah, absolutely. So some of the other positives about asset-backed securities, right? Um, you're getting the cash flow directly from the asset. We're not relying on the credit backing of any agency or the issuer or anything like that.
That's a good point. Right? And that going into understanding asset-backed security and getting that cash flow truly from that pool really causes you to think, I really got to do my due diligence on this pool of loans, these pool of collateral, and what are the steps on it, the characteristics, if you will, and making sure it's adequately structured for us. But I like that you're getting that cash flow directly from them.
Yeah.
Interesting. So, I like the last bullet point, kind of talking about credit risk, because the credit of asset-backed security is not based on the issuer or whatever the wrapper is. This is not right wrapped by Fannie Mae or Freddie Mac. It's wrapped by a trust that is just truly the credit is that pool collateral, and then how is the waterfalls, if there's more than one tranche in there, structured to support each other. So you really, it's interesting, and your credit rating for that pool with that structure can be higher than ultimately the sponsor of that trust. For example, it could be a JP Morgan asset-backed pool, with JP Morgan's rating being lower than the actual pool's rating. And again, looking at the tranche, the credit structure, over collateralization, waterfalls really all rolls into that and allows that to happen.
Now that sounds pretty attractive. What are some of the things I might want to consider, before I come and ask for an asset-backed security?
All right, I'm going to pick my favorite one if you pick your favorite one.
Good deal.
You want to go first or second?
I'll go second.
Okay. My first con on the asset back world is the limitation of the trust assets. It's a positive and a negative because you're going to be over collateralized for $100 million pool of loans. Your security is not going to be 100 million. Your security is going to be 95 million with 5 million over collateralization, or 90 million with 10%. Plus, you have some other enhancements there. But bottom line is if there is some economic event that happens in the environment that really crushes that asset class, and your good example, Zach, is auto delinquencies and charge-offs are really going up. um, I think they're going up, but they're not like terrible times. Like historically, we've seen a lot higher. Once that pool of assets is to a point where it's not supporting all the tranches, there's starting to be write-offs. So it's a very limited group of assets collateralizing this. And I think that's one of my favorite cons, meaning be careful, buyer beware. What's one of yours?
So mine just so happens to be the extension risk, right? I like to try to model that cash flow. That's what I'm doing for my clients is providing steady and stable cash flow. So, if rates do go back up, those are going to extend. I also am worried about the prepayment risk. I think extension and prepayment go hand in hand, and if rates fall, I don't want all that cash back right away.
Right. Yeah, there could be a lot of, either reinvesting in lower environment, or if you happen to pay a premium for this, negatively convex bond, right?
Yeah,
You could be writing off this premium as well. So it could be bad there.
yeah,
So let me put this in context though, because just because we're talking about this, we're talking, market trends where there's value in the market, but we also got to say buyer beware, right? We don't necessarily love having a negatively convex asset on our being put on our balance sheet right now, right?
yeah. Not a big fan of the negative convexity. We've been preaching for a long time now to limit negative convexity. There's plenty of it on the balance sheet, and the investment portfolio is not the place to look to continue to add that.
Yeah. So again, we're going to talk about a couple more products. They're not going to be right for everybody's balance sheet. Your balance sheet has to handle this. It has to perform correctly for your balance sheet and structure and whatnot. But this is what we're seeing in the marketplace and the trend taking place.
Yeah.
Okay. All right, well, let's move on and get into one of the really neat products that's been going on, is commercial mortgage-backed securities, acronym CMBS.
Yeah. So commercial mortgage loans securitized into uh, a bond with a coupon and a final maturity date. Each kind of agency has their own way they approach CMBS. So there could be multiple loans pooled together. There could be one single loan, right? Different structures, floating rate, fixed rate. There's kind of a lot to digest here. It's a pretty, let's call it a complex security. So let's dive into a little bit of the specifics here. So Fannie Mae DUS, this is my absolute favorite in the CMBS right now. I think this is a great story. It's an alternative to a bullet. It has a final maturity date, right? You're getting a fixed coupon that entire time. There's a interest only period.
Okay. You you said it's a bullet alternative. Well,
Yeah.
I don't understand.
So a bullet alternative is something that pays a fixed coupon with a final maturity date. The coupon doesn't change, the maturity date doesn't move, it isn't subject to any movement from
Okay.
interest rates or any kind of negative convexity.
I gotcha. The type of loan that's in there, and that's in that space there, and it's a bullet. Does it have like the actual loan, the structure of a security, from what I have read and understand, is it's got a like a bullet loan in there as well, right? A balloon loan in there, which has a longer amortization. And sometimes those are more often than not are IO type loans with some protections in there, right?
Yeah, some interest only or IO, absolutely. There's typically
Okay.
an interest only period. You're, you're securitizing the cash flow of, only a portion of that total loan. So the risk is mitigated.
Okay. So that's what's really driving towards that bullet alternative there. I get it now. Thank you. And it's got spread over bullets.
Oh yeah, very attractive spread over bullets, right? Same risk weighting. It is agency backed, and you can get almost 10 times what you can get in a typical agency bullet bond. I know we covered that in the last webinar. Somewhere around 5 right now. We're looking at 50 for DUS.
Wow, that is 10 times. That's, now we're talking. Yeah. Okay.
That's what I like to hear, right? We're talking about spread and bringing value.
Love it. Absolutely. Okay. Betty K's, Fresbee's.
So these are structured more like a CMO. They're backed by multiple loans, right? If you are a little uncomfortable with the one loan backing for the security, if you want multiple, feel more secure that way. I know we preach a lot about, whippiness of speeds when we're talking about mortgage-backed securities. So um, that will help keep that cash flow stable, right? Uh, both Freddie and Fresbee have a fixed or floating option. Now, Fresbee does have one where it's fixed to float. We call those hybrids, right? But that's Freddie and Fresbee's.
Okay. Um, I want to talk a little bit about CRA. It doesn't impact everybody on the call, but it does impact some. And it's super important to talk about here with CMBS because I do understand there's some potential for having a security that's eligible for an institution taking credit from a Community Reinvestment Act perspective. You want to shed any light on that?
Yeah, so these loans, you typically get a loan tape, right, where all the properties are. And if you do need CRA, you can hand pick and you can purchase that portion of the securitization so that you're able to get the CRA credit. Now it does come with a certificate. There's a little more paperwork that has to be filled out, but if you do need the credit, it's a great way, to go in, invest, and get that community
Yeah.
reinvestment dollars and the credit for it.
Yeah, for an institution that may not have a ton of opportunities or, that is in high demand for those types of opportunities as well. Love it. Okay.
Absolutely.
Ooh, pros and cons.
I think we listed quite a few cons, right? The spreads are attractive over comparables in that same tenor. I mean, like
Hmm.
we said, 10 times for, DUSs and similar for Freddie K and Fresby, a little bit more, a little bit less. It just depends on the size of the pool, right? And the
Yeah.
coupons.
I do like the concentration comment here, though. It's good to note of this because when we're talking about portfolio management, we can't not think about balance sheet management in your lending portfolio. And if you're not, say, a heavily weighted or at all a commercial lender, right? You're typically going to have lower amount of commercial loans on your books, if any. And this is a great way to get exposure to that market without having the credit risk because it is, like you mentioned, backed by Fannie Freddie. You're giving up yield in the regular commercial loan yield, but it's a great way to diversify your earning assets into a different lending area. Absolutely.
Absolutely.
Yeah.
Great way to, dip your toe into diversification.
Yeah. And buyer beware. Again, these structures are really nice to understand and put on your balance sheet. But, some are trading at discounts, some are trading at premiums, and really truly understanding that risk and doing a good analysis of prepayment understanding is important so you don't get caught. You got to look at those individual securities. You can't just look at just, hey, the whole asset class and just buy carte blanche, whatever comes your way, right?
Yeah, you got to check. Got to check, and you have to be aware the premium and discount can make all the difference.
Yeah, absolutely. Even though there is some good prepayment protection through either prepayment penalties, yield maintenance, those exist in these underlying loans. So keep an eye on that type of stuff. Okay. All right. Well, let's move on to corporate bonds. I think most know on the call what corporate bonds are, but what we're starting to see is a little bit of spread taking place here. And so we felt it was important to talk a little bit about them, and then we'll get into the pros and cons. Excuse me, pros and cons. Yeah, corporate bonds are typically backed by only the issuing corporation, their balance sheet, their full faith and credit of the actual issuer. There's typically not any kind of enhancements, credit enhancements, over collateralizations. There are exceptions to the rule where you can have some, but 9 out of 10 times you're just behind that corporation and how they're going to be performing as an institution. They are similar to other credit-related investments like taxable munis or tax-exempt munis, where you've got to be doing your credit due diligence. What I do like, though, oh, geez, I'm starting to lean into the pros type thing here. Maybe I'll hold off on that for a second. But credit is important to understand when getting into these. A lot of people think that corporates are definitely bullets, meaning non-callable, but you're going to talk a little bit about that as well. Anything else on the description of a corporate bond, tradability, liquidity, things of that nature?
There's plenty of issuances out there. A lot of desks have dedicated corporate bond traders. So these are very liquid securities. The names trade daily. So there's not a concern when it comes to go liquidate these or, do a trade swap, if you will, that we won't be able to find a buyer.
Right. Okay. This is a pretty chart here. What's it giving us here, Zach?
So that green line on the screen is the treasury rate. And what I'm trying, the blue one is double A corporate yields. So as you can see, as we get a little farther down the curve, the blue line and the green line separate, and you're being paid more as you go down the curve for taking that risk, right? 5 years has more risk than 3, right? We're seeing that pickup and the widening there of spreads. So you're being compensated for holding the bonds longer.
Yeah, that having that risk for a longer period of time definitely dictates having extra spread. I get that, and that's smart to be thinking about that. And personally, I think there should be actually more, but it's just kind of a sign of the liquidity that's in the environment right now and the health of corporate balance sheets, quite frankly, as well. It's funny, back in the Great Recession that we experienced, there was some issuers during that low rate environment that we experienced for such a long time where there were some corporate issuers that were negative spread to treasuries. Like your Googles, if you will, that are AAA rated type stuff. And I just found that very humorous. Not that I'd lend to the US Treasury, but so. All right, well, pros and cons here. All right, you get to go first this time on
Ooh,
choosing what your favorite is on the pro side.
my pro is the spread. Corporate bonds are typically the widest asset class. They have the most pickup in yield over the riskless asset. Again, you're taking that credit into consideration. There are premiums, there are discounts, but overall, the spread is typically the widest, even above taxable munis.
Yeah, nice. Well said. And that spread changes throughout time as the credit of an issuer changes throughout time and through industry cycles that not necessarily that individual company is uh, deteriorating or growing, but that industry, they do tend to trade in unison. How do I say, parallel to each other? They both kind of widen in contraction with each other, with the exception of a company doing very well, and then it'll tighten up a little bit because they're just a pristine type credit, or widen if they start to have problems. One of my favorites on the pro side there, Zach, is the piece size. Right? There is
Yeah.
a little bit more liquid of a market when you're coming down to as compared to, say, the municipal side, where, say, for our banks on the call, the bank qualified are very small in issuances. Taxable munis are invested in by everybody on the call, and there's a very limited number of issues, and par amounts aren't very big compared to the corporate world. So those piece sizes are nice, and you can have some economies of scale there, which is cool. Okay. Cons.
Ooh, I got a favorite con.
Do you really?
I
Okay.
do.
Let's hear it.
So you've heard me say it once already on this call, but the negative convexity, the optionality and limiting that most most corporate bonds come with some kind of optionality, whether it's a call 1 year, 3 months, 1 month before maturity date. There is typically a call feature. Now they do have make whole calls on them as well. So, looking at that purchase price continues to be important. Understand what you're buying, right? When is this potentially coming back to me? When am I going to receive that cash flow? Is it 1 year? Is it 1 month? These are all very important things. Do they have the option to call it quarterly for 2 or 3 years before maturity? All of these things need to be taken into consideration when you look at that yield to see if you're being compensated adequately.
Yeah, absolutely. Well said. Those make whole calls are a killer for some people as well, because it might be not anything that the issuer is doing wrong. They're just managing their balance sheet and they're exercising a make whole call on something that somebody didn't expect to be going away. And they're getting called away at potentially of under book value price too. So it's just very complex. Buyer beware on make whole calls. So my favorite on the cons, goes it's there, but I want to elaborate on a little bit, is that credit risk. And maybe not even credit risk per se exactly, because I go down to marketability risk when credit risk becomes an issue. There's a snowballing effect. And if an individual company does run into not necessarily solvency issue, but into a negative cycle of earnings, the trend is not going in their direction, and your spread will widen on that bond, which in your treasury market might not change at all, that riskless curve. So you could be underwater even though interest rates haven't changed, but the credit spread has. And then depending on if they could fall into, say, non-investment grade or something of that nature, it could become illiquid as well. The market could dry up because there are markets out there that can buy investment grade as well as non-investment grade, but there's some that just can't go into that non-investment grade category or world. So you want to be really careful. And these are different than, say, municipal bonds. You really do want to look at their historical financials, see what the trends are, what their ratios look like before entering into it, and then on a quarterly basis, pull their 10Qs and continue monitoring those credits on an ongoing basis, just so you can beat the rest of the market in case there's a trend that you're not liking. Super important. So I think it's one of the biggest cons on the volatility of the corporate market has more volatility than, say, the municipal market on a credit perspective. Yeah. Anything else that we should be talking about on corporate bonds? Okay. All right. Well, let's talk a little bit about the key takeaways there. Want to take one,
Yeah.
two,
So
three?
I touched on it on the last slide, but limiting optionality, right? I'm hearing a lot of clients are being called and tried to be sold bonds with optionality, callable agencies, some callable corporates with, maybe some unfavorable call options, right? I think it's really imperative that we limit the optionality in our investment portfolio. There's plenty of negative convexity in our loan portfolio, and we need to be mindful.
Well said. I want to make sure I emphasize this very well because steepening of the yield curve can't be taken lightly. And what we mean by steepening of the yield curve is that positive sloped yield curve. The positive slope yield curve. We saw a lot of swaps happening in 2024. In the smaller bank and credit union size, under a billion, 25% of the institutions did swaps, mainly because there was higher interest rates, right? But now we've got higher interest rates and a positive slope yield curve. So that can really help make swaps look favorable, take your losses, earn it back, have your balance sheet and income state look really a lot better on a go-forward basis. It really has increased those opportunities that are out there. So make sure to pay attention to that. Take advantage of it, do that analysis because the opportunities exist.
And I think what goes hand in hand is duration and locking those yields out the curve. As you said, the yield curve is steepening. Rates are higher than they were, not at all-time highs, but rates are higher than they were. And now is the time to lock in down the curve. The 5 year is pretty attractive. We can find something out there. Locking in assets over 4% doesn't hurt.
Yeah,
It's
right.
only
I like that. When you're locking in that duration, like you said, with that limited optionality, stay away from those negatively convex bonds. They will hurt you. History will repeat itself for those that are ignoring that limiting of optionality and limiting negative convexity. So, and then we like taxable munis. They're still a great asset class right now from a spread standpoint, right?
Yeah, no, very attractive spreads. A lot of, opportunities for government backing, taxing the populace, strong credits.
Yeah, strong credits. They've been very resilient through our cycles that we've experienced for over the last several decades. CMBS is a very predictable market, a complex market, but very predictable from a cash flow standpoint, spreads over riskless trades. Sometimes a lot more predictable than, say, well, they are, not sometimes, they're definitely more predictable than like a 30-year mortgage-backed security, right? No two ways about it.
No two ways about it.
So we really want to make sure that people really start to pay attention to that market, talk to us, talk to our advisors, understand where the spreads are, get it into your policies, start utilizing those for good market spreads, especially in this environment.
Yeah. And then one of the other things uh, we're encouraging and looking at here is utilizing non-earning assets, right? Making something out of what is essentially nothing on the balance sheet, taking that large gain, equity, capital, right? Visa B, branch share, lease back, and repositioning the portfolio here for success using current coupons and current yields.
Absolutely. It's just a part of overall. And I love that we're incorporating this idea into an investment 201, right? Market trends, what people are doing, making sure you're looking at a whole balance sheet and what's being utilized on it, what's your capital, what are your assets being used for, and how do we better utilize it? And it's just great to have it in there. So really appreciate having that in there for everybody. Excellent. Well, that kind of wraps it up right now for the presentation. One of the questions did come in, Zach, and we do have a couple moments, not many, just a couple moments to actually answer some questions there. And it was actually a question of the liquidity in the market and how we say we like taxable municipal markets, but they are not seeing a ton of availability, even though there's new issues coming through and secondary trading. Seems like all the credits are, here now, gone in 10 seconds from now. Any comment on that, on the availability, and why aren't spreads tighter in that world?
That's a great question, and I want to take a second to digest before I answer it. The Why aren't spreads tightening? You're still taking risk. There's still credit risk involved in purchasing bonds in the municipal space. So while the issuances might be causing some yields to tighten, at some point the market is not going to find them attractive, and we're there. There, there is a risk, and because there is demand, it is highly liquid, right? If you want to turn around and do a swap and get out of some of those, we can do that.
Right. They trade fairly. It's a good example of them trading fairly liquid in the marketplace. And the amount of liquidity, using the same word, but in a different context, is there's a ton of liquidity out there, right? There
Yes,
just
there is.
really is. It's not COVID cash, right? But there's a lot of liquidity out there. And so they are in high demand with those spreads. And there is some perceived risk. And so, again, it's good. There's not all of them are good. Again, credit is tantamount in that world. Another question came in, and they do a lot of, they've been ramping up their commercial lending.
Okay.
And so since they're doing that, what's our opinion on corporate bonds?
What is the opinion on corporate bonds if you're adding commercial?
Right on, right. I think it kind of goes towards concentration of in the space. You kind of think about, you do a commercial loan, you're lending to an institution, right, with loan contractual relationship. On the investment portfolio, you're doing the same thing, but with a security. A corporate bond is basically you lending that money to a corporation for them to pay it back through, the trust indenture of the bond or prospectus and stuff. So I think the balance comes in is how much commercial lending do you have? And we don't want to get too overly saturated, over concentrated into that sector. So if you are 100% more of a commercial lender, right? Majority of your lending is there, then maybe commercial corporate bonds aren't necessarily right for balancing out your credit risk. Maybe the municipal market would be better, right? But if you're lighter on the commercial side, absolutely, corporate bonds can be a good fit. Commercial mortgage-backed securities, absolutely as well. So I don't have any other questions that have come in. So I want to, Zach, Thank you so much for all of your wisdom and knowledge and everything you do day in and day out for all of our clients. I really appreciate you sharing everything today with the webinar.
No, I appreciate you having me here. I hope you were able to glean some nuggets from it and take some things back to your Elcos.
Yeah. Absolutely. Thank you for all of our participants today. I just want to do a quick brief announcement. We do have our mid-year economic update scheduled. It's on June 10th of 2025, and it's at 2 o'clock. So that's our mid-year is June 10th, 2025. You can sign up for that as well as our other webinars. Again, on our website, we have a webinar tab there to sign up. Also, if you're getting emails from us, it'll be at the bottom of the signature of some webinars as well. We appreciate everybody participating. If you want the webinar, you can go out on our website. It'll be up there by tomorrow at the latest, but this afternoon, this will be out on our website if you want to share it with your ALCO committees, with your boards as well. And also, please just reach out to your advisor. We're here to talk and help. Okay, best to everybody. Thanks again. Have a great day.